Hello, this is an intro lesson to step 5 of the Winning with Money program, investing for retirement. And in this lesson, we're going to be covering the basics of investing. So hopefully we can take a step closer to getting involved in investing, especially in retirement. So hopefully during this lesson, I can teach us how to take steps to get started in investing, how we can overcome maybe some mental pitfalls when it comes to getting involved in the stock market. And we'll go over some different concepts. And I'm going to cover the importance of retirement investing, even if you do not plan on retiring. Before we get started in investing, we need to understand our psychology and our emotional approach to investing. There is a lot of risk involved with any type of investing, no matter if it's stock market or a business or something else. There's a lot of risk, and usually the mantra goes higher risk, higher reward, lower risk, lower reward. So we need to understand how much risk we can handle before we start getting invested. So part of starting to understand our psychology behind money and our psychology behind investing, we have to look at a few things. We love gains. We enjoy gains. We love to win as humans, anything, investing, sports, whatever. We enjoy gains a lot, but we do feel the pain of loss, double of that feeling of winning. For example, let's just say on a $50 investment, I made double my money and I earned $100. I feel great, I'm awesome, I'm excited, I feel smart, I feel skillful. But on the same day, a different investment of 50 that I invested $50 in drops to $30. I would most likely focus on that loss, and it would affect me for the rest of my day and the rest of my investing time. And it could also affect my future investing activity because we want things fast. We feel a huge loss in any kind of financial loss or whatever it might be. Even if I lost all that $50 or if I gained $200, I would still feel the loss of that $50 more than that 4 times gain in that $50 amount. And this is known as loss aversion. So we want stuff fast. Another part of psychology behind investing, we want to get rich quick, right? We want stuff fast. We want results right now. We want to have the results in our hands or realize the gains in our investments quickly. But investing should be a slow game. Get rich slow. So building wealth, it can take time rather than get rich quick because most of us cannot beat the market no matter how skillful or smart we think we are. Timidity surrounding the timing, and we're going to talk more about this in a few other lessons in this step 5. Timidity means we're worried about, oh, maybe I'm going to wait till the market crashes, or maybe I should wait another month or so. And that's false advice. I don't know whose people are writing books about this and telling people this, like, oh, timing is the most important, but time in the market is the most important. Just start slowly. Start slowly getting invested. Don't put all your money into one stock or into one investment type. Slowly start spreading it out over time. So building wealth is a slow game. Warren Buffett, for example, made 99% of his wealth after he turned 50, though he started off in a great setting for him because he built his wealth since he was a teenager, since he was young. But we are timid when we entered our investing because of different behaviors or experiences with investing. Or simply, we might just not know. We might not know enough. We might not be educated enough because a lot of us were never taught this stuff in high school or in middle school or whatever, or in college. And market volatility and the risk involved with the stock market may make us not want to enter it in the first place. Managing our level of risk is vital to our wealth and to our investing strategy. So we need to take stock of our risk assessments. There are all types of you can Google this or search on your internet risk assessment tests, and you can kind of see where you're at. Are you more conservative? Are you more aggressive? Usually this depends on age, depends on your income, where you're living, your lifestyle, etc. So taking stock of our risk assessment is important for our retirement investing and our investing portfolio. So how much can we handle if we lose, basically, is what we're looking at. And in this chart, I have investing risk associated with common investment vehicles. So here we have our high risk and then our high reward chart or table. And in this table, we see at the bottom, I talked about this in an earlier step, certificate of deposits, money market accounts. They're the lowest risk, but they're also not going to earn that much in return. And as we start going up, we see bonds like treasury bonds, corporate bonds, exchange traded funds, ETFs, mutual funds, and we keep getting higher and higher. The more risky, of course, the higher reward, but also the bigger chance we might lose. Real estate and stocks, precious metals like gold and silver, commodities, crypto, collectibles. These are, you usually can get a great reward very rarely on some of these items up here. And you can earn a lot of money, but also you can risk losing everything. So you need to be aware of where do we, where should we put most of our money when we are retirement investing? Most people are going to say maybe right here in the middle. And it depends on your age too. People that are close to retirement are going to be closer to here. People that are young and are starting going to be up more towards here, especially in that crypto craze right now that we're going through. So it all depends on your age, your lifestyle, your risk assessment, and such. Breaking these investment types down a little bit more, I made a list of the conservative investment types. So CDs, money markets are the safest, but they in themselves kind of carry a risk because of inflation. So even if you're earning the best on a CD, say 3 to 4% interest, there's still today there's a 7% inflation. So you're still losing 3 to 4% depending on which CD. And that's if you can find a CD or a money market account that's earning 3 to 4%. With inflation skyrocketing, next month it'll probably be 8% plus, and depends on what product and what state you live in too. That's being nice with 3 to 4% earned. So in a way, your money's safe, but you're at risk of inflation. The treasury bonds, a little bit nicer returns, a little bit better returns. Treasury bonds, you're loaning money to the government. Basically, is how all bonds work, whether corporate or government bonds. You loan money to the government. It's like an IOU. You give them that money, and they in turn will pay you interest in quarterly or maybe semi-annually or maybe once a year or all at once at the end of the bond's maturity date. Once that maturity date arrives, they'll give you all your money back, hopefully, and they'll give you the interest on top of that. And some treasury bonds are pretty good. Some treasury bonds are bringing 7% return rate, or I'm sorry, interest rate, and they're backed by the U.S. government. So U.S. government usually pays back their bonds. In fact, and throughout history, they've always paid their bonds and their interest. Corporate bonds, very similar. You loan a company money, and they pay you interest, and then they pay you the full amount of the balance at the end. And it's kind of like a CD in a way because you lock your money into that bond until the maturity date. Mutual funds, thousands of investors, kind of like a collection. Thousands of investors, they pool their money together to invest in broad sectors of the market, of the stock market. So that's why it's called a fund. And this is usually controlled by a manager. It might be a robo manager or it might be an actual manager. And you do have to pay a fee. Anybody that's in that mutual fund collection, they got to pay a fee for that manager to manage the fund and to pick which stocks to invest in. ETFs, kind of like mutual funds, except you can trade them like stocks. And ETFs they're much cheaper too on their fees. So they're still usually a fund manager or maybe some kind of AI program that a company is using. When we invest into an ETF, it functions like a mutual fund. You get to pick a bunch of collection of stocks or you get to invest in a sector or some kind of industry, and you pay a very small fee for that AI or for that manager to pick those stocks and then run the fund as itself. What's cool about ETFs though, you can trade them like stocks. I can buy and sell an ETF all in the same day. And I can do it again tomorrow, and I can do it the next day. So a little bit different from mutual funds because you cannot do that with a mutual fund. You can't buy and sell in the same day. You're invested into it until you want to pull all your money out, but you can't sell it. And more aggressive investments, and aggressive can be a strong word sometimes. Aggressive investments, as long as you understand the risk involved, it doesn't have to be aggressive. And I put real estate in this column just because this is properties that we invest in outside of our homes. Now, real estate is a solid investment if you can get involved into real estate investing, which usually takes a lot of capital. But what I mean by real estate investing in this aggressive investment category is investing in rentals, commercial buildings, running an Airbnb, VRBO, whatever. And this is usually considered safe because you can guarantee that you're going to be generating wealth and generating some type of income. But it can be risky, especially if you don't know what you're doing. It can be a lot of time and money and resources to commit to a project, to a real estate project. Stocks are also pretty risky because you're betting on one company to do well. So you're investing, putting all your money into one company, and you're betting that, well, they're gonna do well. And if they don't, then you lose all that money that you've invested with them. So this is why it's wise to pick several. If you want to invest in companies that you like or whatever, that's smart. Invest in multiple companies though across different sectors. So don't put all into technology stocks, because with technology as a sector goes down, then each one of those companies that you're invested in will also go down. But it is a good way to learn. Investing in companies, putting a small amount into company stocks is a good way to learn and invest in what you know. It's good advice to put most of our investing into funds and maybe a small percentage that we want to play around with into stocks. Precious metals like gold and silver, they do well during times of hysteria. So like times of a recession, during COVID in that March when the stock market dipped, times of high inflation, gold and silver do pretty well. But a lot of people are controversial about how to invest in gold and silver and what's the right way to go about it. But basically, gold and silver are useless because it's pegged to the US dollar. So if the market crashes, if the economy just collapsed and the United States is over, holding on to gold and silver is going to do nothing for us because people are going to be more invested in water and land and guns and ammo and food rather than gold and silver. Some people will disagree with that, but that's fine. Invest in what you know. Agriculture products, they can be a wise investment, especially if you're an expert in that field in agriculture, but they are volatile, more volatile so than in stocks because of the unpredictable nature of the market and of nature itself, of course, and things like oil, wheat, crops, cows, stuff like that falls into the agriculture commodity category, and they can be risky because you can lose everything because you don't have control over it. You can't control, a bunch of cows getting sick, or the oil company not being able to find oil, or their refinery blowing up or whatever because of some freak of nature event. Cryptocurrency, this is a hot item, and with some you can get some great returns. There's stories out there that, oh, I wish I had put $10 into Bitcoin back in 2008 or whatever it might have been. There's some great returns, great stories, but it's still pegged to the US dollar. So Warren Buffett said that I wouldn't give $25 for all of Bitcoin recently. And this is because if US dollar was pegged to the cryptocurrency like Bitcoin or Ethereum or whatever, that'd be a wise move to maybe buy some crypto, but it's reverse. Crypto is useless if it wasn't for modern currency, if it wasn't for fiat US dollar. And then collectibles. Collectibles are fun. They shouldn't be the main investment type. A lot of people, they buy art or artifacts, antiques, rare items, niche trading items. We have a bunch of new stuff today, like NFTs. Those are more like collectibles. Do it for fun. Don't do it for the value of the return that you can get. Probably not. But do it for the fun of investing in something cool, investing in something that you like, that you've studied. That's where we should be focused on with collectibles. And lastly, what should we invest in our retirement? What kind of investments should we include in our retirement portfolio? First of all, do not invest in things that you do not know. If you don't know it, if some friend asks you to invest in a business, that might not be the wisest advice that you've got from them. So invest in what you know. Invest only in your comfort level too. Understand risk assessment. Understand what is involved in your portfolio, what kind of investments that you are getting involved with. Make sure you know the risk involved and know how much you can lose too. And best advice is to understand our retirement. Anytime you're investing in your retirement is long term. It's going to be long term. So most of our investments in our retirement naturally should be more conservative. And if you want to play around, we can always set a small percentage aside to play around with stocks, play around with Bitcoin, play around with NFTs, whatever. This is money that we can afford to lose, though. So when you want to get outside of your retirement, put a little bit, maybe 5% that you can play around with in the stocks. Next lesson, we're going to be covering the significance of investing, the importance of investing for retirement, and why we should do it even if we don't plan on retiring or fully retiring.